I want to talk to you about the difference between starting a company or doing a startup and buying a business, and why I think it's so much smarter to buy a company instead of doing a startup. Hey, my name's Matt Bodnar. I'm a private equity investor, former Goldman Sachs alum, Forbes 30 under 30. I've done more than $100 million worth of deals, and my existing portfolio companies do more than $100 million in annual revenue. Let's talk about the big picture risk profile. The numbers just came out for 2023 on what the difference in the failure rate is between a startup and an established business. In 2023, startups had about a 90% failure rate. 90%, that's a pretty massive number, right? Just off the rip, facing very daunting odds. Versus established businesses, which still closed, had about a 13% failure rate. That means a startup versus an existing business is about 9 times more likely to fail. That's not the only reason that I think it's better to buy companies versus starting them, but I think it's a great data point to start with to say, hey, should we be thinking about things a little bit differently here? So why would you want to do a startup if they have such a high failure rate? Well, you read about in the news the tech unicorns, the big companies that blow up and scale and sell for $1 billion, but there's a huge amount of what's called survivorship bias in those numbers. And that means that a lot of those companies, you hear about the really successful ones, but you never hear about all of the ones that blew up and failed and didn't make it, right? And so that survivorship bias meaningfully contributes to the narrative that, hey, if I do a startup, I'm gonna be hugely successful, right? It's gonna be $1 billion idea, I'm gonna start this amazing company, it's gonna be awesome. You don't hear about the thousands and thousands of startup companies, 90% of or more of those companies that start and then fail and blow up and lose all their money. And there's tons of these stealth wealth millionaires that you never hear about, who are the woman who owns a local plumbing company that does $3 or $4 million a year, and she's taken home $750,000 a year in cash and lives a phenomenal life. They're not writing newspaper articles about. That's not at the top of BuzzFeed or Business Insider, right? You never hear those stories. Those are the millionaires next door. I think buying businesses is a much smarter way to gain a lot of wealth with less risk than doing a startup, because it's much easier to find one of those millionaires next door, to find someone who owns a local HVAC company or a pest control business that's been around for a long time, buy that business, and you're gonna set yourself up to be much more successful than you would if you're doing a startup. So let's look at the math on this. I think the math is very compelling when you compare a startup versus buying an existing business. If you're gonna do a startup, you can bootstrap it, right? You can do it with no dollars and just your relationships and blood, sweat, and tears, but usually most startups will raise money. Similarly, if you're gonna buy a company, you can do it with $0 out of pocket and own a bunch of the business without putting any capital in at all, but most deals, the average deal will have some sort of money that's also raised, right? So we're gonna compare both scenarios without the fancy either bootstrapping with $0 invested or without buying companies with $0 out of pocket. If you're gonna start a startup, typically a startup budget will have somewhere in the $300,000 to $500,000 range in its seed capital round, right? You're gonna go raise money, usually from friends and family, raise a couple $100,000, go embark on that startup journey, right? And that will cover salaries and some product R&D costs and that kind of thing for the early stages of the journey. Now, if it's successful, then you'll go on to raise after the seed round, you'll raise a Series A and a Series B and so forth, and continue to raise capital and or sell eventually. But let's just say, for the sake of this example, you take $300,000 or $500,000, somewhere in that range, and do a startup, right? So, versus buying a company. What do you get when you invest that $300K? Let's take that same number, we'll say $300K, and use it instead of starting a startup to buy a business. So if we take that $300K and invest it in a startup, they're gonna spend it mostly on founder salaries and product development, a little bit of marketing, maybe a couple other things, right? At the end of that journey, you've burned $300,000 or $400,000, and you may, best case scenario, have a product or an MVP, a minimum viable product, something built. The product may not even be finished yet. In a lot of cases, it's not. But let's say that it's completed, and you might, in a best case scenario, have 1 or 2 customers. And then you're gonna have to go out and raise more money to then do it again, to dilute your ownership further and continue on that journey for years and years and years, right? Dilution is another thing we'll talk about in the startup versus buying a business comparison, which is also a really important factor. Now, let's say you take that same $300K. So for $300K, we're basically buying a half-baked product and maybe, best case scenario, a couple customers, right? And a team of 2 or 3 people. That's pretty much it. Let's take the same $300,000 and say we are gonna buy a business, right? So if you have $300K and you use the SBA, which is the most common financing method or one of the most common financing methods for small business acquisitions. It's a great financing program. I've done deals with SBA financing, and I think it's very approachable. Lenders really like it, and it's a great way to get capital because they will lend up to 90% of a business's purchase price with an SBA loan. And the SBA also has a 10-year amortization period. That's a fancy way of saying you have 10 years to pay the loan back. So if you have 10 whole years, most acquisition loans are a 5-year or a 7-year, sometimes even a 3-year term. So the SBA, because it has a government guarantee, has a much longer term. That longer term means it costs you less every year to pay off the loan, and so you have more cash flow available, right? But let's say you take that same $300K, use it as a down payment for an SBA loan. So if you can get an SBA loan for 90% of the purchase price, $3 million purchase of a business, right? You put down $300K, you borrow $2.7 million from the SBA, and you've bought a $3 million company. So what does that business look like that you're getting for that same $300K investment plus an SBA loan? If you're buying the business for $3 million, depending on the type of company and the valuation multiple that it trades for, let's say that business is doing $750,000 of EBITDA or profit or free cash flow, right? At a 4 times multiple, which would be a pretty generous multiple for a business of that size. That's a $3 million purchase. So what does that $3 million business operationally look like? That business, if it's operating at a 15% profit margin, $750,000 of EBITDA divided by a 15% profit margin would be $5 million of revenue. So for that same $300K that you're getting a half-baked product, maybe a couple customers in a best case scenario and a 90% failure rate, that same $300,000 could buy a $3 million purchase of a company that's doing $5 million in revenue with a 15% profit margin and $750,000 a year of cash flow. Now, within that $5 million of revenue, right, you might have $1 million of payroll, $2 million of payroll, right? You're probably gonna have some cost of goods depending on whether it's a service business or a manufacturing company or distributor. Your margin structure is gonna vary a little bit, but let's just say you have $2 million of payroll in that business, right? $2 million of payroll, if you're paying your employees an average of $100,000 a year, which is depending on whether you're talking about service company or a company that is employing a lot of warehouse workers, it could have a very different payroll structure. Just for the sake of this example, if you're paying your employees $100,000 a year, that's a payroll of about 20 employees, right? So that business has 20 different employees that are already working for it, that have been there for maybe 5 years, 7 years, 10 years, have lots of experience, lots of knowledge, lots of existing relationships. If that business with $5 million of revenue has an average client that pays them $100,000 a year, that business has 50 different clients. If an average client pays $50,000 a year, they have 100 clients or maybe even more than that. That's a great amount of customer diversity, right? Customer diversification, which makes a business even more valuable. So just with those two things, you're buying that same $300,000, you're buying potentially 50, 100 or more customers, you're buying a payroll of 20 employees, you're buying a business that could have a 5, 10, or 15-year operating history, a track record, a reputation, a presence in the marketplace. You also have one of the most important things is product market fit. That business is doing millions of revenue a year already. There's a known product, there's a known demand for it, and there are existing customers. Versus a startup, which the number one reason that startups fail, lack of product market fit, right? Lack of product market fit because you don't know if the product that you're trying to build, if there's even demand for it or if it's something that customers actually want. That's why it's so interesting to buy a business versus starting one. Now let's talk about the math, right? That same startup, $300K, maybe you have a customer or two, maybe you have a product built in a better case scenario, not even talking about the 90% failure rate, versus buying that $5 million in revenue business, doing $750K in profit for $3 million. That SBA loan, the debt service or the payments on an annual basis for that loan, depending on what assumptions you use, if you say it's a 10% interest rate, which is pretty expensive, on a 10-year term or a 10-year amortization, your debt service or your payments are gonna cost you about $430,000 a year to pay that loan off every year for 10 years. Sounds expensive, but you're buying a business that does $750,000 a year in profit. So $750 minus $430 is $320,000 a year of additional free cash flow that you have left over. right? If you put in 300K as your equity and you distributed all of those excess profits to yourself, you would have over a 100% return on invested equity year one, right? So you could put in 300K, make 750 over the next year, pay 430 to the bank, and take 320 back into your bank account for not only getting all of your money back, but also another $20,000. So the math is pretty crazy, right? Versus a startup where you're gonna sink money into that thing for 5 to 7 years, even in a great scenario, without seeing any return at all, and then hope and pray that you get a 5x or a 10x on the equity that's been invested in that business. To me, it's almost ludicrous to think about starting a business versus buying a company because of those same dynamics. The other thing that we haven't even talked about is that as you build a startup, if you're constantly raising money, you're gonna continue to get diluted, right? Even huge founders of big companies end up owning like 8% or 9% or 10% of their companies. And sure, if the company is $1 billion business, that can be worth a substantial amount of money, right? Gary Vee always talks about number 18 at Facebook is worth a lot of money. But 99.99999% of businesses never end up like Facebook, right? I've personally invested in and founded multiple different startups that have crashed, burned, and lost me hundreds of thousands of dollars. I've also founded and started businesses that have been very successful and raised millions of dollars in venture capital. So I have a pretty good understanding of what the marketplace and what the dynamics look like for that. I've also bought a number of cash flowing businesses doing millions of dollars a year in profits and EBITDA. And now I spend 100% of my time doing that because I think it's a much better risk reward profile. The math screams that it's a much better idea. Certainly, there are risks associated with buying any business, right? There's also risks associated with starting any company. In fact, there's risk with pretty much everything in life, right? I could get struck by lightning in 2 seconds. The building I'm in could collapse. I could get hit by a car on my ride home today. You have no idea, right? There's an infinite amount of potential risks in this life. And so at some point, if you're going to take risk, I want to de-risk or mitigate those risks as much as possible. And that's why I personally think buying companies is a much smarter strategy than doing startups. So let's recap. Would you rather take the same dollar invested, let's say 300K, and put it into a startup with no customers, no revenue, no product market fit, and no traction? Or would you rather take those same dollars and buy a business with $5 million of revenue, $750,000 of profits, 20 employees, 100 plus customers, a track record of operating in the industry for 5, 7, 10, 15, or 20 or more years? I know which of those I would rather select. I think it's much smarter to buy businesses versus doing startups. There's no doubt that there's risk in both of those paths. Taking out an SBA loan has its own whole spectrum of risks that come with it that a startup doesn't necessarily entail. You have to do your own homework and figure out what kind of risks you're ultimately comfortable with. But I'm curious, I'd love to hear your experience in the comments. What's your experience been with either startups or acquisitions? And what's your perspective on choosing one of these paths versus the other? Thanks so much for listening, and I'll see you guys in the comments and in the next video. If you like this video, check out the next one.